Hello everyone, welcome back to my channel. So recently I heard there's a lot of discussion about buy the dip. Especially I saw on the Robinhood a lot of individual investor run to the stock has a relatively lower price. In the top 100 popular Robinhood stocks, I can see some stocks has a very low price such as GoPro and Aurora Cannabis. So today I want to talk about my thoughts on buy the dip, whether that would really help investors make money, and also how I would pick the stocks that would have a long-term growth. So now let's get started. So first I want to compare two stock examples. The first one is GoPro. The current stock price is $4. And if we are looking back in 2014, the stock price has been $88. So comparing with 2014, which is 6 years ago, the stock price currently is not even 1/10 of the price, and it's pretty cheap. So would you buy the stock because the stock price is low? That means $4 would be cheap stock to buy. And the next example is Google. When we look at in 2014 September, the stock price is around $587. And you can see that from 2014 to 2017, the stock price has already increased significantly. According to the thoughts of a lot of investors, if the stock has keeping increased a lot, the stock price become expensive and it may not be a good time to buy. But from 2017 to 2020, the stock price continued going up. The current stock price is more than 1,500 and it's more than 3 times of the stock price. So in 2017, you probably see Google price is very expensive because it has grown so much from the previous point. And if you look at the GoPro in 2017, the price point is almost below $26 and it's relatively cheap. So if the investor buys GoPro versus Google in 2017, and the return is very obvious to see that Google has so much more return than GoPro. So that makes me think whether we should buy the stock that has decreased a lot and hoping that it will bounce back. Actually, that was my idea when I was just started investing 2 years ago. And I always buy the stock has a big drop, like drop 5% in one day, and I would be hoping for that the stock will going up in the next 1 week. But after a while, I find this method doesn't work that well, and that's why I turn to the long-term investment. I just figure out that the short-term swing trade is very risky because as an individual investor with limited information, it's very hard to predict the stock price in the short term. And I gradually realized that there's two types of money stock market investors make. So here is a chart showing that. The x-axis shows time, while the y-axis shows value. That is the value of the stock. And the stock price will be shown in another line, which is very fluctuate as market going up and down because investors are not 100% rational. So the first type of money investor made is the growth of the company, and that's a more long-term growth in this period. And the second type is in the short-term period, like what a lot of swing traders or day traders did. They take the difference between the true value versus the current price and they make money from it. Of course, there's both successful traders from both strategies, and since I need to do the daily work, I cannot look at the chart all the time. So that's why I choose the first one, the long-term strategies. And in order to pick up the stock, I need to do a lot of research. And I think there are several criteria that a lot of long-term investors usually look at. The first one is PE ratio, which is price divided by earnings each quarter when the earnings came out. So usually we see the PE ratio change from time to time. And every quarter when the earnings come out, if the earnings is higher than expectation, the stock price will going up, and then the PE ratio will going down, and vice versa. If the earnings is less than expectations, the stock price will going down and PE ratio will be higher. So when we just looking at the PE ratio, it can reflect whether the stock price is on the higher level or on the lower level historically, but it would not necessarily predict the future price movement. Although there's a forward PE ratio, but those would be changed from time to time according to the earnings each quarter. So if we have the confidence in specific stock, we are very sure we want to hold the stock. PE ratio can just be a factor to see whether it's expensive or not, but not because the only reason to buy the stock is because it's cheap. And there's also some other method we can evaluate the stock, like EPS growth that I've mentioned in my previous videos, and also returns on equities. So when I see the earnings per share has grown executive for 3 quarters, I know the stock has formed a momentum and the stock price is probably going up. And for the ROE, as Warren Buffett say, like he mostly look at the ROE larger than 20%, which means the company can make money, and I'll also take that as a criteria. But I think the most important part to predict the future stock movement would be whether the company has a moat that can win over the competitors from time to time, and the competitive advantage is sustainable. I think in order to determine whether the company have a wide moat and can achieve a long-term competitive advantage, the investors need to have a deep understanding about specific industry. I think that's also why that Warren Buffett said he don't invest in some industries or some companies he don't understand. So I think that's very important for the investor to know before you make any decisions. So to sum up, I think buy the dip sometimes work and sometimes not. It depends on which company you're buying, and picking up the right company is the first step of your investment successful. And I think the most important thing is whether the company's growth can be sustainable and can achieve long-term success for like 5 years, 10 years, and 20 years. So that's all my thoughts about the recent discussion about whether we should buy the cheap stocks. Hope it provides value to you guys, and I will see you guys in my next one. Bye.